Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, we're going to be talking about using charts to plan an option trade. But it's not just a stock chart. We're going to be talking about three different types of charts that a trader might consider looking at before going ahead with an option trade. I think it should be a really good discussion. Before we get into the particulars of what we're going to be covering today, let me first of all say hello to everybody that's joining us out there in YouTube. Always nice to see the familiar names out there. So hello there, Selva and Pinocchio, Jack, Jackson, Josh, Eva, Tony. Who else is here? Dragon Rider 108. Everybody else, thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. But if this is your first time here in this webcast series, welcome. It's great to have you here. I hope you enjoy the show, and if you're watching on the YouTube archive after the fact, we'll enjoy the presentation. But be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series. We kick things off promptly at noon Eastern time. If you'd like to be here in the live stream, we really enjoy our live audience members. Also want to let you know that my very good friend Connie Hill is going to be hanging out in the chat. She's going to be addressing any questions that I can't get to during the presentation. Connie is an absolutely fabulous coach and presenter. She brings a lot of knowledge and experience to this discussion. So thanks for having my back there, Connie. And Connie and I would like to issue an invitation to everybody listening. If you have an account with X, you should be following your favorite presenters there. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. It's the best place to connect with your favorite presenters in between these live streams. But let's get into this discussion. And the first thing that we need to do, of course, is to pause to consider the risks associated with investing and trading. Risk is real, so bear these important disclosures in mind. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. We're going to be planning and placing an example options trade using the thinkorswim desktop platform. But as we do that, we're going to be looking at three charts that some traders consider to be essential in the planning and placing of an option trade. So I'm going to be taking us through a quick look at these three different charts and then placing that example trade. Should be an interesting discussion. The very first place, where do you think we're going to go first? If a trader is considering some sort of an option trade, what might be stop number one for not necessarily every option trader out there, but I think a good number might consider this to be the first place to look at our first type of chart. It's a chart of the S&P 500. Now, there might be another index. Some traders will look at the S&P. Others might look at the NASDAQ if they're trading more NASDAQ securities. So still others might be looking at the Dow or the Russell. We're going to be using this index today. But really what we're trying to do here is get a gauge of where stocks in general seem to be going. How many of you could attest to the fact that the performance of most types of portfolios that are based on equities or options is largely driven by just the flow of the markets. So if we get it wrong, let's say that our trader is really good at bearish option strategies, and yet they persist with those bearish strategies in a persistent bullish market, are they going to perform? Probably not well. On the other hand, sometimes we look back over the course of the last 6 months or the year, we notice our portfolio is doing extremely well, and a lot of that performance can be attributed to, well, we were just on the right side of the markets, whatever they determined to do. So the first stop for some traders is to see what's going on with equities, with stocks, and the S&P is going to represent those stocks for us today. So we're on the S&P 500, and here's what some technical traders, chart users, might look for. They might look to see, well, what is the current trend? With the assumption being, well, if a trend has been going in one direction or the other and nothing dramatic changes in the economy or other fundamental factors, that trend is possibly just likely to continue. So starting back here in April, we can see that the S&P started a recovery from this big sell-off from mid-February. That recovery's been sharp. Look at this. We're now only 3% below those all-time highs on the S&P 500 after diving down 22%. I know that was kind of ugly to look at the 401k balances at that moment. But what some traders will look for here is coming off these lows, they look to see what are the short-term cycles of an index doing. They might look for an index, and this could carry over to individual stocks, running up to peaks, pulling back down to troughs, running up to subsequent peaks, pulling back down to subsequent troughs. Where those cycles or stair steps headed? Are we going higher or lower? Eva says, yeah, the bull flag pattern from yesterday. Yeah, it was, so we called this a pennant, but yeah, it falls into that general category of bullish flag patterns. Yeah, I thought I'd just leave that on the chart, add some consistency from my Monday to Tuesday webcast. Yep. So good call out there. But what some traders may have already noted is that we had this sharp run up from these lows, pull back down to a subsequent low. But boy, that low here in the third week of April did not get even really close to the low that we had in the first week of April. Then we pushed up to a new high, exceeding the high in between those initial lows. And as we pulled back again, that's a pretty shallow dip right there to the start of what some traders might see as this flag pole of the flag of this pennant pattern that I've drawn on my chart. In any case, when a market or an index seems to be heading higher like that, for some traders, that is a huge deal, and they may plan to initiate just bullish trades, just in keeping with that trend. Because if that trend continues, that can go a long way to just assisting those trades towards success. But I did note yesterday, and Eva called this out correctly, there's been a sharp run-up that some might call a flag, or a flagpole, and then a consolidation of prices into what we might consider to be a pennant pattern type of a flag. And this, to some traders, is seen as a bullish continuation pattern when it shows up on a chart. It just means stock moved up explosively, went through some consolidation where maybe the buyers were short-term not as enthusiastic, but still adequate there to push any selling back to baseline. And then you'll notice after our discussion yesterday, it looks like we're pushing up and through the top side of that pennant pattern. So could be prices are set to go back up to these highs, maybe beyond. Time will tell. But let's say that our trader here is maybe planning a trade for this July expiration. There's the third Friday expiration, July 18th. And if we're trying to determine, well, between now and July 18th, might it be better to have bullish trades or bearish trades in play? Maybe the first decision to make is, well, do we think that the S&P itself is likely to be higher or lower? And maybe that could cause, a rising, I don't like screwing up my phrases. Rising tide lifts all ships, something like that. Yeah. So that's a little bit of an exaggeration with stocks. Higher S&P does not guarantee that all stocks are going higher, but it might improve the likelihood of success on a bullish trade. All right, so let's pin that as our first stop on using charts to plan our option trade. And let's say that our trader thinks something along these lines is likely to happen. Now, obviously, that's a simplification. But we think that in general, stocks might be going higher. So that's a look at the markets from a stock perspective. But what about the markets for options? This is going to be our second type of chart. For some traders, before they go place their trade, they take a look at what stocks are doing, but also the general pricing of options. Sometimes a trader might find themselves in more of a buyer's market for options. Sometimes the trader might find themselves in more of a seller's market for options. And so let's go have a look at that condition. And we're going to use a volatility index. And our example of volatility index here is going to be the VIX. It's the market volatility index for the S&P 500. It's a projection of expected volatility over the next 30 days, basically, just to simplify what this chart means. But for an option trader, that volatility can be key in Determining one's expectations for whether options prices generally are likely to rise or fall. And you might think, well, doesn't that just mean bullish or bearish? No, that doesn't mean bullish or bearish, because there are times when just because of market conditions, calls and puts can get some downside pressure. Prices can be falling generally. There are other times when the general price of calls and puts can be rising, and that's strongly related to volatility. When volatility is increasing, that can drive demand from put buyers and call buyers in the form of speculation. Rising volatility might just look like a lot of potential to those sorts of traders. It might also look like risk to other types of traders. So the hedgers might increase the demand for calls and for puts for whatever strategies they're using to hedge a portfolio. But rising volatility typically associated with rising option prices, falling volatility typically associated with falling options prices. And boy, volatility has been falling for months now. It had a little bit of a boop, little pop up, but seems to be falling again. Thank you, everybody, for the positive sentiments out there in chats. That's definitely appreciated. But we hit this little upswing here on volatility. That can give a little bit of a boost to our buyers who maybe bought recently. Volatility goes up. It helps out the increase in premiums generally, not every contract on every stock, but generally. But since then, we've been falling. And let's say that our trader here has looked at the S&P 500 and they think stocks are likely to go up, but maybe their conviction is that volatility is likely to drop down to what they might consider to be kind of a baseline down here. Is that guaranteed to happen? Of course not. But as we're looking ahead to July 18th, they may be weighing, well, does it look like volatilities are more likely to be lower or higher on July 18th than they are today? And that can help them maybe decide between initiating a new options trade by buying something bullish or initiating a new option trade by selling into something bullish. And so if we think that volatility is likely to come down, just like if we think prices on houses are high and falling, maybe a homeowner might consider that to be, that's kind of a seller's market. Sell now while prices are high. Yep, that might be the outlook here for our traders. So here's our second stop along our way to planning our option trade. First, in deciding whether to do bullish or bearish trades, let's say that our traders decided to be bullish. Second, in deciding whether to buy or sell into a new option trade, maybe they think it's more of a seller's market. All right. Eva, you're saying sell short puts, of course. I'll kind of grant you this, Eva. It's going to be a variation on that theme. But there's one final step we might need to take, a third type of chart. We looked at the markets. We've looked at the market for stocks, basically. We looked at the market for options, basically. Well, what about the individual stock itself? Yep, let's do that next. So I've selected a stock. We're going to be using Chevron. This one might be surprising to some because it's had a rough last, 2 months. Go to that chart. Look back here to April. Chevron got absolutely punished for about 2 weeks. That was at the height of the tensions in the tariff back and forth. It might have looked like a lot of shipping might get locked up. In any case, there could certainly be other contributing factors here to the drop in Chevron's in the demand for Chevron products. But in any case, we've dropped down to about the 135 level. So our trader is now moving from a broad perspective of what's happening with stocks and with options to now planning a specific trade using the stock chart. And with Chevron, as we fell down to 135, that's interesting. That's pretty close. You can see there's a pretty good collection of activity down here around that 135 level. And that's pretty close to the lowest that we've been all year. But if we were to extend this out to a longer term time frame, let me go out to a 10-year weekly chart. You'll notice 135 has been a support level for CVX stock prices going all the way back to 2022. And previous to that, that was a price ceiling. So for some technical traders and using their stock charts, they may look at previous price floors and price ceilings as maybe an indication of where those price floors and price ceilings might be in the future. So looking at this, maybe we're starting to see some strength off that floor, and it could be our trader's conviction that this stock looks bullish from here. Is all of this, having gone through all of this trouble to use these three charts to start to get the first grains of an options trade planned, is all of that a guarantee that this stock is going to go up in price? No, we're just trying to do our best, right? But there we go. So bouncing up off these 135 lows, actually price has strengthened all the way up to 140. It was a little bit softer. When I was first looking at this earlier, we were down around 138, but going in the right direction. Let's see if we can plan a trade that would be optimized as of this July 18th expiration, as long as we're still above 135. Now, there's a possibility we could continue on down below 135, but that's not something that's really happened much in the last several years. There have been a few days where we've ducked down below, maybe closed for a day here or there below that level, but we've been strengthening above that. Now, it's not just the chart that's used by options traders in selecting a stock for trading of options. We've talked about this a number of times. Some traders will also look at the liquidity of the stock. They'll also look at the price per share. Those were considerations for me in selecting this, but it's not a universal outlook for everybody. But that's going to be our example stock for the day. Let's go place a bullish trade built around selling that suits what we're seeing on this stock chart. So CS says a short put vertical on CVX would be ideal. Well, that's the idea that I had. Whether it turns out to be ideal, we'll know on July 18th. I don't know that today. That's what I think. That's what I think the example might be today, but we'll see. Let's go to the trade tab though. Let's go to July 18th and let's plan our trade. So I'm going to come down here and remember that support around 135. Let's look at the 135 put. And this is going to be our example trade. Let's open up our scratch pad, give ourselves some more space. Let me close this up here so my camera shot's not going to obscure your view. But our example trade will be a short put spread, also known as a short put vertical, abbreviated to SPV by Sia in their comments. Let's make this bold. And a short put vertical is built generally around the concept of selling a put. Selling a put is a bullish option strategy. It's where a trader is accepting a payment from somebody else out there in the options trading universe. So the payment is the driver of the trade. It's the motivation for the trade, but it comes with an obligation. Here's what this one's going to be. We're going to look at that selling maybe that 135 put. So let's look to sell the 18th of July, 135 put. That looks like that's trading between 239, 245. Let's say we can just get 240 for that put. So the 240 times 100 shares is $240 that we're conceptually being paid here. So that's the motivation for the trade, but it comes with it. It comes with an obligation that someone else has the right to sell shares to us for $135 per share through the 18th of July. Even if those shares collapse in value, we still have a contractual obligation to pay $135 for those shares. So that can be a tough pill to swallow for somebody that doesn't want that much risk to the downside. So what they might do is at the same time they sell that 135 put, they buy a less expensive put to try to mitigate that risk. And in this case, we're going to buy the 18th of July. Let's maybe look at doing the 130 put. If we buy that 18th of July 130 put, that looks like that's trading between 129 and 135. Let's call it 130. So now we're spending $1.30, not £1.30. $1.30. There we go. What does this put do for our trade? Well, spending $130 for now the right to sell those shares. If we get stuck with shares, we now have the contractual right to unload those shares to someone else if we need to. It's not that we want to, but if we get stuck with shares at 135, we could sell those shares for 130. That would be a $5 loss. We don't want to be buying shares at 135 and selling at 130, but at least it puts a downside maximum, a theoretical maximum here. So that limits the risk. How much is the theoretical max loss on this trade? Well, if we have to buy shares at 135 and we sell them for 130, that would be a $5 loss, except we did upfront collect a net $1.10. Set this trade up. So that's a little bit of a consolation prize here. Will leave us with $3.90. That could be lost as our theoretical maximum loss. The maximum gain here is just the net credit received. Here's what the trader really wants out of this trade. We collected $2.40 for the one option, spent $1.30 for the other one, and what we're really looking for is for both of those to just expire worthless. So we get to keep the $2.40, someone else keeps our $1.30. Between those two things, we've made $1.10. So that's our trade. So this is a trade scenario where, at least in the way that we've structured this, there's almost $4 of risk for every dollar of reward potential on this trade. Why in the world would anybody take such a trade? Well, because it's actually quite probable that we're going to be making that dollar. It's less likely they're going to be losing the basically $4 here. There's a probability displayed right here on our chart, right here on our option chain. If we look at that 135 put, it has a delta of 30. That tells us there's a 30% chance that this contract is in the money. Now, delta can tell us a couple of things. It can tell us the degree of leverage on an option, but it can also give us an approximation of the likelihood of a contract being in the money at expiration and being assigned or exercised. So this has a 30% chance of being assigned at expiration. By extrapolation, there's a 70% chance that nothing happens at expiration. It just expires worthless. There's a 70% probability of making that $1.10. Now, how much of a probability is there that we lose the $3.90? That would be accomplished if our stock fell all the way from where it is right now, 140, down below 135, down below 130, and both of these and our contracts wind up getting assigned and exercised. Well, if we look at that 130 strike, it has a delta of 18. There's only an 18% chance that the stock falls far enough that we choose to exercise that contract at expiration, and we have our maximum theoretical loss. So that kind of explains for some traders why they're totally fine with this sort of reward risk scenario. I know it can kind of feel nice if we can at least make $1, maybe $2 for every dollar of risk. But those high reward scenarios in options trading are typically associated with low probabilities. This is just the opposite. This is a lower reward scenario with a high probability of success. So that's going to be our example trade today, that 135, 130. I'm going to map this out on our chart because I think for some people that's beneficial. They can help, it helps sort of visualize what's going on. So our 135 is the put that we're selling. We already have a line there. Let's draw a second line just down below today's candle at 130. Right about there. That's close enough. And I'm going to carry that out to expiration. And this is going to be kind of our no-fly zone. I'm going to edit this. Let's make that one red. This is where we don't want the trade to go. And I'm also going to draw in a little box right there. Let's draw a box down here. This is where we do not want the trade to go. So we'll make that one red. And where do we want the stock instead? We want that up here. As we move toward expiration, it really doesn't matter. The higher, the better. Basically, just makes the trader feel better that we're less likely to get assigned on the 135 put. So we'd like to be up in this green box as we move toward this July 18th expiration. If you'll notice, look where we are right now. In great position for that to happen. If the stock goes higher, it puts us in even better position. If the stock goes sideways, that's okay. If the stock comes down, maybe we get a little bit nervous, but as long as we're above 135, we're still in position for maximum theoretical gain. It's really just if we fall down below that 130 where we're in our position for a maximum theoretical loss. So that's why I have these boxes down there. We're going to see how this trade pans out. Dragon Rider says, feeling good, never paid you money. I think what you're referring to there is the reward risk trade-off. Once again, yeah, it can feel good to know on a strategy that we can make as much as we stand to lose or multiples of what we stand to lose. But and we've structured those sorts of trades before that they just have lower probabilities of success. I think you can see why this one has a 70% chance of success. The math tells us that it has about that chance for success, but also just eyeballing it from where we are right now. Stock could go higher. Let's assign that a probability of 50%. Well, if it goes higher, it's just getting better. The stock could go lower. Let's assign that a probability of 50%. Well, lower doesn't mean collapse. It just means lower. Even if we go from here down to there, we're still going lower, but notice this trade has a tolerance for some distance of lower. So maybe there's a few percentage points of probability that we fall down to 135, and actually it'd be about 20% that we land somewhere between 135 and 140. I know that because we have about a 70% probability of maximum gain. In any case, yep, high probability of success. One thing that I want to make sure that we address here, though, especially for those that are new to options trading, we're in these two contracts, and we have to think ahead to that expiration event. If we decide to let this thing go all the way to expiration, we have to know what may happen at expiration. What could happen at expiration if we didn't go down to max loss territory, we're below max gain territory. Let's say we're at $132, just to pick a number between 135 and 130. Well, if a stock's at, let's say, 132, and someone has the right to sell shares to us for 135, are they going to do that, especially if time has run out on them? Yep. That is an in-the-money put option. They have the right to sell it to us for 135. They can't sell the shares to anybody else out there for 135. They'd have to just sell it otherwise on the open market for 132. So they assign that contract. They sell us the shares of Chevron for 132. And you think, that's okay, Cameron. I'm covered. I can sell those shares to somebody else for 130. Yeah, we can, but do we want to? That would be underselling the market. Nope, in that case, our long option just expires worthless. We get assigned the shares. We wake up Monday morning and we own 100 shares or 200 shares or 300 shares. Maybe we weren't planning on owning. So yeah, the risk is particularly elevated of owning shares that we didn't intend to own if we're within or inside that spread and we get toward expiration. Now, early assignment risk is always present, even if we're out of the money. It's just that this is when it's most pointed. So I wanted to call that out. Okay, so how about let's place this trade. Well, let's go back to the thought of using charts to plan a more complete view of the trade. What about exiting the trade? What might a trader consider doing if the stock really is just falling and falling and falling when they thought it was going to rise? They could attach an exit to that scenario, right? So let's do that. Let's say that if our stock is falling, we could attach an exit to the share price. I want to talk about the pros and cons of that. Let's do that today. let's say that our trader is in this bullish strategy and they're going to stick with it right to the end. I wouldn't say the bitter end if it's going up, probably the better end if the stock price is going up. But if it starts to slip below 135, their tolerance for sticking with this trade might run a little bit thin. And let's say if it gets down below these recent lows, let's just get out. Una says, what happens if the trader doesn't have enough cash to cover the assignment? Could leave us in a little bit of a sticky situation. If it's in a margin account, there may not be full cash requirement for the purchase of those shares, or they might have to sell the shares, because it sounds like a nightmare scenario, doesn't it, Una? Holy cow. Let's say we do this contract and we get assigned those shares at $135 a share. That's a $13,500 purchase. And let's say the shares are only worth 132. Let's just stay with the same example. So we spent $13,500. What might the trader do on Monday or Tuesday or whatever to get some cash to pay for that purchase? Well, if the shares are worth 132 and we own 100 shares, that's $13,200 that could be recruited by just selling the shares. So what's the difference? It's $300. So even though it can sound like, wow, we're really in hot water there, the shares that we have purchased still have their market value, whatever that is. All right. But yeah, see, let's place a conditional order. What was the lowest point on this candle? That was actually, look at that, 132.04. Let's just say 132. That seems to be a running theme right now. When I pointed a candle, we can look up here at the L, and that tells us the low of that candle. So yeah, 132.04. Let's say that our trader says this is a bullish strategy. As long as it goes higher, we're fine. If it comes down, that's okay. If it starts to go down below these lows, maybe my chart theory here isn't working. I thought it was going to stay above 135. Now it's gone all the way down to 132. Let's just get out of it. So here's how that trade might be placed. Let's go to our trade tab. Here's a quick way to do a vertical spread when the two strikes are in order, in sequential order on the strike chain there. We can just choose spread single, change that to vertical, and it just pairs them up. So there's our 130, 135 strike pairing. I can click on the bid price to create that vertical spread. I'm going to hide this left column. We don't really need that anymore. Looks like our credit might not be $1.10. Let's try to get $1.05 out of this. But let's also attach a sell order to get us out if the price happens to fall down at any point down to that 132 level. How would we do that? Well, instead of placing just a single order, let's change that to a first triggers sequential order. So if our first order fills, it's going to put a sequential or a second order into effect. That'll be our exit order. So now we just right click on the original order and create an opposite order. So this now is an order to sell into this contract or into these contracts for $1.05 and then buy out for $1.05. That's not what we want. Let's change the condition of this buy order. I'm going to come over here to the little gear icon. This actually brings up a condition screen. And this is our order to buy back those contracts. But I'm going to change this. That's not what I wanted to click on. There we go. To a market order. Good till canceled. What in the world are you doing? Well, I don't want a market order right now. I want a market order if CVX, the market value of CVX happens to fall down below 132. I know that's kind of squished. Can't quite see it. There we go. Click on something else so you can see the 132. That's our threshold. So we're just telling the system, hey, if Chevron, if the market value or the price of the stock happens to fall down less than or equal to $132, kick off a market order to buy out of these contracts for them. Save that. And that's how we might add that condition. All right, now, final thing I want to do, could have done this earlier. Let's backpedal a little bit. Do we want to just do one contract If this thing completely blows up, and it still could on a big gap down, even if we have a stop in, conditional stop in at 132, if the stock just has a huge drop on a terrible news announcement or something, there's still 395 at risk here. So let's just call it 395 bucks of risk. In this webcast series, I typically try to keep the risk at under $4,000 per trade. It's grown a little bit. This was a $200,000 portfolio. I'm going to still say 200,000. I was just keeping the risk at 2% per trade. Okay. Now that's not to say everybody should do that. That's just the example here. So if one contract represents about $400 of risk, let's do 10 contracts. So let's change our entry order to 10. Let's change our exit order to 10. There we go. And let me see. Kevin says, Mr. May, what about just taking the loss on the short leg and let the long put run if the trade goes against us? Would that be an option? Lol. Yeah, that is something that a trader could do. There's a risk that they take in doing that, though. I would guess that with 195 people watching, somebody out there's probably done this. You don't have to admit it, because I know I can feel awkward to admit when you've had a loss, even though losses happen to everybody. So we have this bullish trade that consists of two options. One of them's bullish, one of them's bearish. So the concept here that's being proposed is if the stock starts to behave bearishly, well, let's get rid of the bullish one. The bullish one is the short option. So we close out the short put, probably at a loss, expecting, well, if it's behaving bearishly and it continues to behave bearishly, maybe the long option can still make good money for us. So, but what can happen though is we take a dip, get out of the bullish one, and then it runs up, and now we're losing more than we originally planned for. When we say theoretical max gain or theoretical max loss, it's because there are other scenarios before expiration or at expiration that can introduce new risk or new reward potential. That's one of those. If we start to tinker with the structure of the trade, it can change the reward and risk scenarios. Okay. Kevin, you say you've taken losses on both ends that way. Vic, you say we all do. Yeah. There we go. Yeah, pros and cons to that, though, because the concept there, it's not that it's a flawed concept. We just have to remember pros and cons. And if it happens to be, if the short put is holding up the trade, if we're just taking losses on the short put and we get out and the stock continues to fall hard, well, now we have the potential to make money on a long put, just as if we had been in a long put all along. Okay. Good question. But let's click confirm and send. I think the price of these has gone up. So the 105 looks like it's likely to fill, but time will tell. We're going to sell these 10 verticals, the 135, 130 put, trying to get $1.05 out of this. If we can fill those 10 contracts, that gives us a maximum profit of $1,050. Gives us a maximum loss of $39.50. That's under our $4,000 risk tolerance. There is a commission to be paid on each contract on both sides, on both legs. So yeah, that's where the 13 bucks comes from. And there's a little heads up. Hey, due to potentially wide markets or liquidity risks at the time of activation, this order, that is referring to the exit order here, may be manually substituted with a limit order upon activation and worked until filled. So yeah, this is to get in, hopefully for $1.05, and get out if we fall, if CVX falls below 132. Now, do we have the luxury of knowing if it falls down to 132, the extent of the damage to our vertical at that time? Hopefully it's not maximum, but no, we don't know exactly how much loss we've taken. It would probably be on order of about halfway to max loss, but there are other elements at play, not just price, but also time and volatility can play a role. Also, let me send this off, and I want to address one other thing. When we put in an order to exit, we might think that we've covered all of our bases. Nope. What if the stock never goes down below 132, but it looks like we filled at 109? Okay, great. What if the stock goes down, just not down to 132? What if it goes down to 133 and we hit expiration? Well, we're facing that assignment risk again, where we're assigned the shares. We don't exercise our contract. We wind up owning some shares that we didn't intend to buy. Okay. All right. But guys, we have accomplished what I set out to do today. I think it's been a good discussion. We wanted to talk about 3 very different types of charts that might be used in the planning and placing of an option trade, a stock index chart, an options pricing chart, the volatility index, and using the individual stock chart to plan and place that options trade. I hope that was a good discussion for you. This is what we do on Tuesdays. I do hope that you'll put it in your personal calendar to join me on Tuesdays if you can make it. It's totally fine to just watch the archives. That's great too. But I'm going to set you loose to go enjoy the rest of our educational offerings. But as you go, just remember the other resources, the best way to optimize the resources that are available to you here from Schwab Education. Number 1 is that if you haven't subscribed to our YouTube channel, make sure you do that. You can go down to the lower right-hand corner of the video stream right now and click on the subscribe button. That only takes a second. It doesn't cost anything, but it subscribes you to our Trader Talks Schwab Coaching Webcast YouTube channel. And that is where we house our playlists of our concluded our webcasts that have already been delivered. You can find those right here. So for example, some of you might really want to brush up on stock charts. Maybe you just don't know a lot about those. Well, you can go to the playlists, and I actually have put together a playlist right here, new to stock charts. Start here. Click on view full playlists, and there's a series of 8 lessons for new traders of using stock charts. Now, another thing that I want to remind you of is you can find us on X. Give us a follow on X. You should be following your favorite presenters on X, but you can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. There you go. If you found this guy with that Scottish background and this precise handle at Cameron May CS, you know you're following the right one. Janelle, thank you. Mohammed, Vicky loves Florida. Mike, Mighty Mouse, see ya. Everybody else, glad you enjoyed the presentation. I'll see you again next Tuesday. I do appreciate everybody that's already given the thumbs up. Out of 163 people watching live right now, 56 have already clicked that thumbs up, right at 1/3. That's awesome. Thank you for doing that. That gives a boost to my video, and the YouTube algorithm helps more people find these sorts of discussions. Maybe they can learn about using charts to plan an options trade. It's also just a nice pat on the back to your presenter when you click the like button. And that's another thing that doesn't cost anything. It only takes a second. So if you've enjoyed a webcast, click the like button before hitting the exits. And everybody, go have a great day. I will look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.